Welcome back to our webinar series, Developing Superb Trading Strategies. My name, as always, Stefan Friedrichowski. It's really nice to see you back here to our webinars. And by the way, thanks to Algo-Trading who make that webinar series possible. Yeah, you know that I have been on vacation 3.5 weeks in Colombia, so that was really a great experience. I'm safely back. As you realize, voice is still there, and nothing has been to report on any damages or whatever else. So it was really a great time that I can say. So whenever you may plan a trip to Colombia, you can get in contact with me as well, not talking about trading, maybe talking about that really nice country. You know my email address, friedrichowski@argosfx.com. You know that email address is valid for any other more trading related questions as well. So yeah, it was really great. So now I have to get adjusted to climate and time shifts again. But at least sun is still here in Germany, but totally different temperatures. So temperature difference is about 30 degrees. Okay, but let's not talk any longer about Colombia, even if that would filling an hour, of course. But we go further onwards with our developing of superb trading strategies. Yeah, and you see already the topics for today. I condensed them to just one topic, more or less, and that is swap trading strategies. So we touched already the topic in the last webinar, which is, I think, 4 weeks ago, that we talk about swap costs and swap gains you may achieve or you may get from your broker. And that is really a quite interesting topic. I have made some thoughts about that during my holidays, and you will see what came out of that later. So that topic is really interesting, and I hope that I can invite you a little bit more to talk about that, because maybe I do some mistakes, yes, so that can be, and you will see that today I follow some lines of argumentation, and maybe they are wrong, so that's of course possible. But I hope that maybe you can correct me if any thoughts or any calculations are wrong on that topic, because you will see it's really tricky. We can do a lot of things with swap trading strategies. And finally, the target is here to may find very small profits, but with very low risk. And what does it mean in general? If we talk about something with small profits but very low risk, then of course we can increase our lot sizes and whatever. So we know how to leverage that kind of topic. So even if I talk about profits in the region of cents and a few euros, there's always a simple chance or method to scale that up. So therefore, even if those profits are small, it's still quite interesting, because to scale them, that is easy. So, but what I'm talking really here about, let's go through this, by the way, and I will report on the performance of the Lambda strategies you may follow at Argo-Trading as well. So that will be the last part of today. You might notice already that I have uploaded the slides so that you have already all the links, maybe to previous webinar recordings or other links, because I have other links today in my presentation I find quite useful, so it's easier to share those via document than just looking to the screen or just writing them down. So you can download the slides via the GoToWebinar control panel, so that's quite easy. Last remark before I start, risk warning as always, you know that we talk about trading strategies, and finally, if you do something similar, of course, you do it on your own. I have to make that remark always, but I know that you understand me absolutely right there. Good. Questions, answers from last week. That slide is quite empty because there was nothing to report. Maybe you did not write me during my holidays and asking specific questions, but so I'm thankful for that. But if there would have been some questions, of course, you can always get in touch with me. So, swap costs. I just want to introduce once again in that kind of topic. That's one slide from the previous webinar a couple of weeks ago, just as an introduction that we know what we are talking about here. So, in general, swap costs, they appear and you will find them in your account. That normally, yeah, you borrow money by your trading activities, and therefore it's more or less straightforward that we have to pay an interest rate on the borrowed the money. So the reason is that we trade with high leverages, and therefore we move around much more money than we have on our account. And moving around money means you have to borrow money, and that results in money which you have to pay. So this just the interest rates. But that is a little bit too short looking for that kind of definition, because we do long and short trades, and we can do both, and therefore the story becomes much more complicated. If, for example, you just not think about forex pairs, let's think about indices or stocks or something like that, then there is a normal straightforward thinking. And that normal straightforward thinking is simply if you go into a long trade for a stock or an index, then normally you have to pay money. But if you enter a short trade on stocks or on indices, then you earn money. So even nowadays, because we have still this interest rates which are close to zero, even that story is not really completely true. You may find brokers which have for long and short trades both negative swap costs, which means you have to pay money in both directions. But anyhow, let's keep it right now a little bit more simple. But what does it mean finally for forex trading? For forex pairs, it depends on the involved regions. So think about you trade Australian dollar against US dollar. Then the question is, what kind of interest rates do you have in which region? And now it depends on the naming of the forex pair. So in my case, it would be called Australian dollar against United States dollar, and not vice versa. So we have those standard definitions of forex pairs, but in principle, the forex pair US dollar against Australian dollar is valid as well, but that's not the typical naming. Therefore, it depends on the kind of naming, and it depends on the involved interest rates in those regions. If you do something like that and looking for those, then and that is just a table I presented already last time, then you might just only look up to now to that first part here, and I will sort them, by the way, in the order of naming. That's a little more simple to look at. So just look right now to my table here on the upper left side, then you realize, okay, for example, Australian dollar against Canadian dollar. Then for a long trade, you may have even gains, so profits. So you will earn money when you enter a long trade on that forex pair, and you would have to pay that amount for a short trade. So, and the numbers here are, I have recalculated those numbers from the specifications of Argus FX. You find all those within MT4 just by going or looking to the so-called specification of a forex pair, and I calculated those values down to real euro numbers for one lot. For one, if it would trade exactly one lot. So you see that there are, more or less, there are some forex pairs where you have the situation that in both directions you have to pay money. But in most cases, there's always one direction where you can earn money just by holding that trade. So if we would assume that the price relation, so the forex pair itself would stay constant, then you would see exactly that amount of money adding to your account every day. We will talk about the so-called 3-day swap day later. So on Wednesday, it's always 3 times higher, but let's keep that for later. So you see, if the forex pair itself would not change, then you would earn money every day. If you enter a long trade on Australian dollar against Swiss francs. So, and you see that more or less, besides some exceptions, there's always one trade direction which would generate money, and the other trade direction that you would lose money every day. And that was a final point last time, that we realized, okay, if you, for example, if you do, let's say, normal trading activities, you may use that kind of information as an additional filter. So, for example, simple rule, I will only enter trades where I find positive swap values. So that would be a simple rule. It would generate you in total a little bit more earnings. Of course, you might miss some opportunities on the then other direction, but you see, I have here 28 forex pairs, and if you just look for some trading activities every day or however you do it personally, you can use simply that kind of filter. That's easy. And that's, by the way, not bad to use that filter for long-term trading activities on forex pairs, that you use exactly that filter. That would already increase your profitability. It's not that much, but if you have those trades really running a couple of months, then you see what does it mean. So, for example, if I would have a short trade on Australian dollar, Swiss franc, then I have to pay nearly 8 euros every day for a lot. So after 10 days, already 80. After 100 days, already 800 euros. So it's not that small on a long term. By the way, now that was the starting position. But now let's go into what are my ideas really dealing with those swap costs. And I will present here 4 approaches for swap trading activities, and every of that idea, or each of that idea, I give a certain name, and the name already is telling you a little bit about the strategy behind. Honestly, there are 2 of those approaches which I'm still not sure. Maybe I make a mistake. Maybe there is something hidden I not aware of right now. So, But anyhow, let's discuss it, and maybe you can give me your input to that as well. So the first one is called the millisecond trade. Basic concept, just that already right now, basic concept here is because the swap costs, they are not really calculated time-wise. They are charged to your account, or also the profit is charged to your account exactly at a certain time. Normally, most brokers do it at 11 p.m. German time, by the way, and then you from 1 second to the other, you will be charged with those swap costs. By the way, just thinking reverse, what does it mean if you would have a trade open and you simply would close it at 1 minute before? Of course you can do, and you would reopen the same trade 1 minute after 11. Then you would not be charged by those swap costs, but you have to pay the spread once again. So closing a trade and opening a trade means 1 times additional spread. So therefore, we have to take the spread finally into account as well. But let's look to the millisecond trade a little bit more in detail later. But just to give you the overview, the second approach is that maybe it's a good idea to combine 2 brokers. Think about maybe I find a broker with some profits for a certain trade direction, and I can find another broker where I would open the reverse trade, and maybe that broker is not charging me more than I gain with the other broker. If that's the case, then I have a neutral trade because I would enter a long and a short trade, same currency pair, and the trade in total would be neutral. And if my profit on the one side is higher than my loss on the other side, I have a neutral trade, and that might be a good opportunity. Why not? Let's look into the details later. Then we know, just looking to those 28 forex pairs as my table on the other slide, we can think about maybe we can combine a lot of trades, a few short trades with those forex pairs, other pairs long, short. So we have in total 28 forex pairs in my table, and we can combine those, and maybe it's possible to come to a total neutral trade and still earning money by the swap costs. So, not that bad. Let's look into that as well. And final approach here to mention is what I call the long-term trade. I will already show you what triggers me to that kind of trade. And by the way, that is a trigger why I look to all those things here. Simple answer. You see that's a demo account at Argus right now, and on the 4th of January, I have opened a couple of trades in that account, and I picked forex pairs just by do they have positive swap values? So it was not the complete list. I looked to them and I tried a little bit to neutralize everything so that I maybe find already some combinations, but the combination was not neutral in the final end. And I opened those about 14 trades here. And now the astonishing thing after my holiday was simply that I looked here, okay, my total profit is nearly 200 euro. So the trade itself as a sum are positive. And of course I find positive swap values here in that list already. So that money is already on my account here. And not really when I close the trade, to be formally correct. So, but the question was, hey, I simply, without any look to the chart, I simply opened those trades just by looking to the swap cost table and looking for those which generate profits. And now, after a little bit more than 1 month, I find, okay, those 40 trades, I have those swap profits, and my profits, and I have additionally profits on the trade itself. So is that only random and maybe just picking the right forex pairs, or is there maybe a little bit more behind? And it seems to me that there's a little bit more behind. I know that it's not a real statistics we do right now here, because it's just 1 month or a little bit more than 1 month, randomly or not just selected, and that's the result. So let's take it as a single data point, which is positive, of course, but maybe we can find some argumentation on that as well. So that is the final part, that is a so-called long-term trading approach. Let's dig into that a little bit more in detail. So the millisecond trade, simply let's go to the basics here. The swap costs, or the profit, they are charged at 11 p.m. typically for the most brokers. So in principle, it might be possible to do something extremely simple. Let's think about, you open a trade 1 minute before 11, and you close the same trade already 1 minute after 11. And finally, that's the name. That's the reason for the name millisecond trade. You might do it really a millisecond before 11 and a millisecond after 11. So therefore the name. So if our swap gain would be greater than the spread, and we have to take commission into account as well if we have a broker with commission, if the swap already would be bigger, greater than the spread, then we would generate a profit. Under the assumption that the price of the underlying does not change within the millisecond. And but do we have a chance? And let's have a quick view to the same table I presented already, and then you will realize, oh, it will be hard. So those numbers here in euro are the profit or loss for one lot. And typically, if you have a good broker, then you can think about a trade just looking to the spreads and or commission. For one lot trade, you would lose about 10 euros simply because of the spread of that trade. And just take that as an average number, which is not really correct for all the forex pairs, but just that we have something to compare. And now you see, okay, unfortunately, there's no number within the table which is bigger than 10 euros. Good. So it will not work. If you do that millisecond trade, just opening, getting the profit of swap costs or profit, swap profit, and closing the trade in the next millisecond would be not high enough here because all those numbers are too small. Okay, but there's another chance, and this another chance is simply on Wednesday. The reason, what is a little bit strange about Wednesday is, yeah, all the brokers, they charge on Wednesday 3 times higher values for swaps. And the reason behind is that they want to represent, let's say, the complete 7 days of the week. And since at least some brokers, they have totally closed on Saturday and on Sunday, there is the they cannot charge those days. And what they simply do is they do the charging already on Wednesday. So whenever you open a trade on Wednesday before 11 and you look the day after to your account, then you will find, hey, they have charged you 3 times the value of what you find as the specification of the forex pair, and therefore this is always called 3 days swap, 3 swap days or 3 days swap day. And that is typically on Wednesday. On the other hand, that is a chance. So I can once again look to the same format here and look to my table once again, because I can, maybe it's a good idea to do it only on Wednesday, which would be still enough, why not? So the highest number you find here within the table is this one, British pound against New Zealand dollar. That is close below 2 euros. That times 3 is about 5 or 6 here in this case. So it's still not enough. Okay, so because I have to compare it to 10 euros, I would lose simply because of the spread of the trade. So right now, it's not enough, but let's wait. What do I mean with let's wait? Right now, most of the regions, they have quite low interest rates. So the highest interest rate for those 8 currencies I have been looking here, the highest interest rate is right now in New Zealand, and they have an interest rate of at the Federal Reserve of 1.75. But maybe if we get higher differences, maybe still Europe stays at 0 and they will increase and increase and increase for whatever reason, then that has an impact on that swap table, and that would finally mean maybe if that number would double, then already on Wednesday we would have a chance. So let's see. So it will be interesting. Up to now, it's not possible. At least not right at Argus FX. You will later see that I will compare to other brokers as well, and there you may find higher swap values, so higher profits. And let's see, maybe we can find already a broker where we can use at least on Wednesday that simple rule. Still, I make a question mark behind that strategy because it really sounds a little bit too simple. But I will follow up on that because it would be really interesting. Still, there's one assumption, and that assumption is if the price does not change during those milliseconds for this that kind of trade. So I would still have that risk that the price changes. Anyhow, so give it a chance, keep it in mind, but right now, at least at Argus FX, it would not generate money. Okay, but let's go for the next one. And the next one goes the following. We just take 2 brokers, and you may find brokers like here. Just my example, broker A, and I would open there a short trade on Euro US dollar, and I now go for another kind of how brokers publish their swap prices. One possibility is to do it simply in bips and not in euro as translated in my other table, but just it's quite easy to compare those numbers here. So we may find a broker A with short swap profits of 0.01 bips, and we may find a broker B for a long trade in Euro US dollar, and this broker may charge us with 0.06 bips every day for a long trade on Euro US dollar. So if I have now both trades open, I have a neutral trade. Neutral because I would buy one lot at the one and one lot short at the one broker and one lot long at the other broker. So I'm, from a market perspective, I have a neutral trade. There will be no resulting net changes for the trade, but I have to pay the spread when I open the trade. On the other hand, I would gain this 0.25 bips per day. And yeah, let's do a simple calculation. I now assume that I have spreads. I even increased that a little bit more here to 1.5 bips. So my total costs for that trade would be 3 bips. That would mean after 12 days, I become profitable with that trade. Only under the assumption that that net profit does not change, or at least it should not go in the negative. If it would go smaller, then it would only take a longer time. So, but now here's the first link here once again to my FX book, because there you have an overview to the swap costs. And let's look to that web page whether my assumptions here with those two brokers are possible, entering a short trade with 0.31 and entering a long trade with a charge of 0.06. And let's go to that web page here. So that is this web page. And before I go here a little bit more in detail, I want to remark that it's written here on the web page that when you have later here the different brokers, they may use different types of how to publish their swap prices. And you will find here type 0, that is the one most of the brokers will use, and that type is in bips, type 1 in symbol-based currency, and so on and so on. So later I will only look to brokers of type 0 in bips, as already on my previous slide. So here you see that there are lots of brokers, and you find a table with all the long and short costs and this type. So what I now do is I sort those euro-US dollar swap prices. That was my first click, and then I sort them once again by type, because I want to have them in the same order. And let's go to the complete list. And now you see, and we start here with type 0, and you find, okay, there's a broker with short, not the profit, they will charge you that amount, and so on and so on. Hey, that's an interesting list here. And you see, the list ends here with Huntech Markets. Sorry, I really don't know that broker. There are a few brokers here I know, but that broker I do not know. And I see, okay, this 0.01 bips. Good, that's the one on my slide. And now I sort the same list for long trades, and once again, additionally to the type. And then you see my list with types ends here. There are a few brokers which simply don't charge any swap prices, so they have another instrument how to charge you. But what we find here, so I don't go for those 0 ones, because I'm sure that they do something else which is not published here. But Wanda, that is a broker I know, that is a possible broker, and they would charge you this 0.06. Hey, and now we have those numbers. And by the way, you find a little bit other numbers as well. So it's an interesting idea here to look into that. So you can do the same for every forex pair, and you may find even more profitable ones. So in principle, that does mean it sounds possible. At least what I have here up to now found out of those tables. Going more in detail would really mean opening live account at those brokers, and then really looking, do they charge exactly those values as published, and so on. So there are still some question marks, but it sounds possible. There's still one condition here, and that question I cannot answer right now. How stable are those swap rates which are published here. So not the publication should be stable, but the values should be stable. At least what we would need here, that we need 12 days with the same values. Then from the 13th day onwards, we would gain money. But that is something I have to look into a little bit more in detail. So I will do screenshots of those tables for a couple of days, and let's see how big are the changes from day to day, because we would need at least 12 days here. So interesting approach, and would make a market neutral trade, which automatically would generate money. Still, that sounds a little bit too good to be true, but at least from my current analysis, it sounds possible. Okay, but I have more ideas here. And the next one I would like to mention is simply the group combination trade. What do I mean here? So now I go back to, I would do it at one broker. So that would be much more easier to go live with that idea, doing those activities exactly with one broker. And what I do here in the first step is simply that I show you an example. What do I really mean with a combination trade? And that would be an example. So my combination here would be out of 3 trades. The first one, Swiss franc, Japanese yen, short. Euro, Swiss franc, short. And Euro, Japanese yen, long. And now, look a little bit more in detail to the naming here. You will find out in total, those 3 trades are market neutral. Why can I say that? So let's start with 2 and 3. You find Euro as a first name here in that Forex pair, and Euro as a first name in the third Forex pair. So you may know that I always talk about first name and last name within Forex pairs in order to get to the point here. And what does it mean? So Euro is in the first name, Euro in the first name, one short, one long trade would mean the Euro is out. So whenever the Euro itself would change, those two that has no final impact on those 2 trades, because we have one long and one short trade. Now let's look to the first combination here. Swiss franc is here in the first name, and in this for the second trade, the Swiss franc is the last name of the pair. Both trades are short, but now that means Swiss franc cancel out, because here one time first name, one time last name. Both trades are short, so Swiss franc has no impact on the total behavior of those 2 trades anymore. And then we have Japanese yen, first and 3. In both combinations, Japanese yen is the last name, and we have one short and one long trade. So it would mean Japanese yen is out. Finally, the complete trade is market neutral. So whatever might happen in those economies, countries, to those currencies, finally, if we would enter those 3 trades, we would not see any final result of those 3 trades. So therefore, I call them market neutral. Now it comes the but. Now I put the numbers out of the table presented already earlier to those trades. And you see, okay, Japanese yen, Swiss franc, Japanese yen earns money, Euro, Swiss franc loses money, and Euro, Japanese yen is neutral. Okay, the 3 trades are market neutral, but finally there's no net profit out of the swaps. Okay, but we have more opportunities. Let's think about that in general. Here, what I did up to now is I looked to 8 currencies, those 8. And what we now can do is we can do a lot of combinations with those 28 forex pairs. But by the way, most of those combinations are not market neutral. What do I mean here? Let me switch to my Excel sheet once again. That's quite easy. I quickly guide you through that Excel sheet. By the way, that number here is not, it's only because I want to show you something here. So here we have those 28 forex pairs. And now I have simply do it here in this Excel sheet, I do it random. So and whenever I press F9, you will see my combination changes. I have my 28 forex pairs, and I assign a number, -1 for a short trade. I assign a 0 if I would not trade that forex pair, and I assign a 1 for entering a long trade for that specific forex pair. So in this case, it would be a short trade on Australian dollar, Canadian dollar, and so on and so on. And you see, in total, this would right now here generate 19 trades. The next step here within the table is to ask, do I have a market neutral situation for those, in this case, 19 trades or potential 28 trades? And that is, I asked the question first name, last name, and do I have a long trade or a short trade? For example, what does it mean here? The first trade is a short trade on Australian dollar, Canadian dollar. Good. So therefore, I find a -1 in the column Australian dollar, and I find a +1 in the column Canadian dollar. This goes further here. Next trade, Australian dollar, Swiss franc. That's a long trade. Therefore, I put a +1 in the table for Australian dollar and a -1 for Swiss franc. And that I do for all the 28. And then I sum up what I have here. And if I would have only zeros here, then I would have a total market neutral total trade. So that's, by the way, I do here by that calculation. That's not really the sum of the 8. It's the sum of the absolute values, because that should be 0 to have a completely market neutral trade. And you see, in most cases, of course, it's not market neutral. You see that I do randomly here new considerations, and sometimes it's getting even to high values here, which would mean, okay, that combination of trade is highly not market neutral. What's missing here up to now is the swap costs or profits. And by the way, we cannot do it here with Excel and not do it systematically. It would simply take too much time. So I go back here to my slide, and you see the number of possible combinations is simply 3 to the power of 28, which is really a big number. That is the, in principle, possible number of combinations for those 28 forex pairs with the 3 possible situations: short, long, and no trade. Therefore, it's 3 to the power of 28. And once again, most of them are not market neutral. But the good thing is, I don't not only have Excel, I can do it here with a C program, and you see already what I do here. Even if I'm not that familiar with computer programming, you see 28 for loops which go now through the possible parameter space, and then I put all the numbers of my swap costs in the calculation, and now I get For the combinations, I get the answer to the question, what is the total gain if I would have that, or loss trade? And I have the answer to the questions, how close do I am to the market neutral situation? And what I can tell you is, and I don't want to go here into the details, but the result I want to share with you. There is no combination which is completely market neutral and still having a sum of for swap costs which are positive. There's simply no combination like that. But there are combinations which would generate money, which would in total I would earn money via swap profits, but they are not that market neutral. So, for example, I pick out now here one line, and that one line. Now let me take another one. How to read that? You find those numbers 12, 10, 14, and so on, and that is a non-market neutrality. So that is exactly the number like in the Excel sheet. And by the way, then you have here all the 28 forex pairs and what kind of trades are in there. But now all the numbers switch by exactly one. So the first forex pair would be not opened. So that's the one, that's the neutral, and so on and so on. You don't have to understand the details here, but I only want to share with you the results. So it's not possible to have a completely market neutral trade, which is still earning money via swap costs. And maybe that's not surprising that this is not possible to find such a combination. But I can have values which are closer to that. So they are at least a little bit better. Not completely market neutral, but now the question to be answered is, hey, if I would go for those trades, maybe it's not too bad to have violated the market neutral situation, because it might turn out that those principal trade directions are not that bad. So still, that means I don't have a final answer here to the group combination trade, how to prove we can go for that. I know now that it's possible to come closer to market neutral, but that would mean there's a final risk. And just to go into that, because now we would have remaining risk because of the trades itself. Let's have a look into that as well. So still, that means on my to-do list, this group combination trade is not finished, but let's go to the last approach for swap costs trading strategies. And that is now, I call it long-term trades. And before I go and show you already some results on that, I want to build a line of argumentation. And honestly, maybe therefore I make the remark here still to be discussed, because I simply draw a line of argumentation here, and let me go through it. So let's start with the interest rate of euro, which is, by the way, 0 right now, and Australian dollar, which is 1.5. And by the way, you find the link here in my slides, because I found a web page where they publish the interest rates, and even you find the historic of those interest rates within those regions. So that are the numbers. That's our starting point. Euro has an interest rate of 0, and Australian dollar an interest rate of 1.5. So what does it mean? So that is the amount of money the banks have to pay their federal bank when they borrow money. But typically, if you would have normal interest, if you put money on your bank account and you asked how much do I get per year, the higher the interest rate of the Federal Reserve, the higher the interest rates are which you get on your account. Simply putting money to an account and wait a year. So if I have that situation, then there would be a demand for Australian dollar, because it's nice to invest in Australian dollar, because there I would get money on my bank account if I would have money on that account. Therefore, there is a higher demand to the Australian dollar. If there's a higher demand, then the value of the Australian dollar would increase. As always, that's the normal market rule. So demand is high, prices go up, or the value of that thing increases. That would mean I would get for 1 Australian dollar finally more euros. So for 1 Australian dollar, I get now more euros than before. And that means that the euro Australian dollar, this forex pair, and that is what we trade, would decrease. So that would mean a short trade on Australian dollar, on euro Australian dollar, is interesting in that situation. The complete line is only because if I talk about things like that and I simply look to the name euro Australian dollar, I have no clue what does it always really mean. If the one goes stronger than the other, that's always something which puzzles me, and therefore I went to the complete line of argumentation here. So that means a short trade euro Australian dollar is interesting. And now the good thing. Looking to the swap gain, the swap profit for a short trade on euro Australian dollar, hey, exactly for that forex pair, we find a quite positive profit per day out of swaps. Hey, that's interesting. And now the question is that true for others as well? And what does it really mean? And I've done really something quick, which is astonishing. I go back to my Excel sheet here. What I did is I selected here out of that list all those which have the highest values for swap profits. So I took a few of them here, so long trades on those forex pairs, because there I would earn a lot of money, and I took those 3 here for short trades, and which give me profits here. And then I did the following. I simply asked the question, okay, I did it yesterday. So what I did is I wrote down the actual price of that specific forex pair for yesterday. That was somewhere during the day, but it's not really dependent on the time within the day of yesterday. And I compared the price with exactly 1 year ago. So out of the chart, I took 2 values, yesterday and 1 year ago. And then I realized, okay, Australian dollar, Swiss franc, good. The price has increased. Nice. By 10%. So that trade itself would have generated already profit. And if I would do a 1 lot trade on that forex pair, it would have generated a little bit more than 6,000 euros just because of the price change, and I would get additional swap profits on top of that. So now you see I have done the same for those 8 or 9 forex pairs, which are only selected by having a high number of swap profit. And what really was astonishing doing that analysis for those 8 forex pairs, that all the, now let's call it simulated trades, so all simulated trades out of the 8 have been positive. That's really interesting. So because I would have expected that at least we're looking to 8 trades here, that are 1-year trades, that a few of them would have been negative, a few of them would be positive, and no, all of this 1-year trades would have generated profits by the trade itself. And now maybe I reverse my thinking. The selection has been done because of swap profits. And that was, by the way, the original target, just earning swaps. But now I realize if I would have made those trades which have been selected by positive swap profits, I would have even generated much more money out of the trade itself. So now, new question. It might be good to enter exactly those trades long term, which generate swaps, but then finally they might generate even more profits out of the trade itself. So still under consideration. I can tell you what I do. I have already asked the broker that I can get those swap values historically. I have the swap interest rate, the interest rates of the Federal Reserves. I can take those out of that web page mentioned. But I know that this is only the complete story. The interest rates of the Federal Reserves are not the complete story to generate really the swaps values. But still, it seems to be interesting to follow that line. By the way, if I would have done really those trades, that would have meant that there has been no stop loss and nothing. So coming back to that issue, looking to the complete table, out of that table means, okay, still it's absolutely a good and fantastic thing, just only opening trades into those directions which generate swap profits and not swap charges. That's of course a good idea. But now it seems that this is even more valid. It seems, with statistic 1, I admit, up to now, that is indeed the preferred trade direction of that forex pair. So let's put a big question mark behind, because it's not proven. It's only done by here this 1-year consideration of price changes, and all of the 8 get good numbers. So it's already quite promising, but that's not enough. So finally, it means good idea as well. So entering long-term trades into those directions which generate the highest profits per day out of swaps does not look bad. Quite interesting, but needs additional historical consideration, because of course I know, and let me go to that webpage here as well, where I picked up the numbers for the interest rates. You see here you have for a lot of regions and countries, you have those numbers, and just by clicking on one, that is United States, for example, you see here starting from 91 until today, you see the long-term interest rates changes, and of course you see that for the last 6 years we have been close to 0, and now for 2 months we have the first changes, at least in the United States. So those numbers are here, good. But now it needs further consideration in detail with broker numbers for the actual swap prices they would have charged. So interesting thing, at least to my mind, looking out of the swap costs to some good trading activities. So seems to be good. But now let me quickly go to the performance of the Lambda strategies. The other topic I will, of course, move forward for the next couple of webinars. So where do we stand, or where do Lambda is right now with those strategies? And you know there are 4 strategies running, and you see that right now we have positive and negative values. In total, they would cancel, by the way, nearly to 0, at least a little bit to the minus. But so we have one strategy with minus 3%, and the best one is here with plus 8% from the starting point. But that is typical behavior, so it's nothing to be worried about, or so still within what is absolutely normal. So, and by the way, you can find those numbers always by your own, simply going to the web page of Argus FX and then going to the Argonaut. And if you want to have a specific look on that, so you can go to select those Lambda accounts, and then you have the same numbers here. And they are always, by the way, actual. So same 8% here. And just clicking, for example, to start an account, then you get even the historical behavior as well. So from the starting of that account until now, you find all the details, all the symbols which are traded, and so on and so on. Good. That's for now. By the way, I forgot to make a remark at the very beginning, and I put that slide here on top. Next week there's no webinar, but the week after there is once again, of course, the webinar. It's simply I'm out of office on Thursday next week, so that's the only reason. So therefore, in 14 days we will have the next webinar. That's for me, that's for now, and hope you enjoyed that webinar. Any questions, just send me an email as always. You're welcome. Okay, have a good day and have a good week. Bye-bye.